Selecting the right counterparty determines your revenue model, operational costs, and competitive positioning. The wrong partner locks you into unfavorable terms or creates execution bottlenecks. This guide covers A-book and B-book models as business strategies when aggregation makes sense and what to demand from potential partners. An liquidity provider is an institution, typically a Tier 1 bank, hedge fund, or market maker, that quotes continuous bid-ask prices and acts as counterparty to client trades. 3 core functions. 1. Market access to institutional pricing unavailable to retail clients. 2. Order execution with sub-10 ms latency. 3. Risk transfer to offload directional exposure. Without these relationships, you are limited to acting as principal for every trade. While viable, this creates significant risk concentration as you scale. Business models compared. A book. Route client orders directly to external counterparties. Markup on spreads or fixed commission per trade. Capital. Lower operational requirements. Partners may require margin deposits based on volume. Risk. Minimal directional exposure. You are a spread capture business. When it works, professional clients, predictable revenue, regulated markets with strict net capital rules. Challenges: lower margins per trade, need significant volume for profitability. B-book. Act as counterparty to client trades internally. Revenue: client losses, spread income, optional hedging profits. Capital: significant reserves to cover drawdowns, strong risk systems. Risk: high directional exposure. Potential for outsized profits during losing streaks, significant losses if clients win consistently. When it works, strong risk infrastructure, primarily retail client base, higher margin appetite. Challenges: regulatory scrutiny in some jurisdictions, reputational concerns, sophisticated risk management required. Hybrid operations. Most firms run hybrid models. Profitable professional accounts routed externally, retail losing accounts kept internal. High-volume clients routed externally. Algorithms monitor performance and automatically shift accounts between models. Regulatory landscape. A book, universally acceptable. B-book restrictions. European Union and United Kingdom, allowed with disclosure and capital adequacy. Australia, permitted but scrutinized. United States, effectively banned for retail Forex. Confirm compliance before building infrastructure. Types of counterparties. Tier 1 major banks. JP Morgan, Citi, Goldman Sachs, UBS. Characteristics: deepest pools, best pricing, institutional execution, high entry barriers. Best for: established operations with institutional or high-volume retail clients, Tier 2 regional institutions, mid-sized banks, proprietary trading firms. Characteristics: good depth on majors, competitive pricing, accessible entry. Best for: growing firms, regional focus, prime of prime. Intermediaries like Leverett, 1.0 offering white label access. Characteristics: aggregated access, lower barriers, technology included, higher costs. Best for: startups, rapid market entry, less control, dependency on intermediary infrastructure. When you need aggregation, an aggregator connects you to multiple sources simultaneously and routes each order to the best available price. How it works: connect to 5-10 counterparties through one aggregator for each client order. 1. Poll all connected sources for quotes. 2. Select best price, tightest spread, or custom logic. 3. Route to optimal venue. 4. Backup routing if primary fails. Benefits: better pricing. Competition drives tighter spreads. Redundancy: orders route to alternatives automatically if one source fails. Deeper books: aggregate depth handles larger orders. Selection criteria. Pricing and spreads. Request historical average spreads across sessions and during major news. Ask about markup structure. Execution quality. Request fill time statistics, rejection rates, slippage data. Contract terms. Understand total cost, minimum volume, deposits, setup fees per trade costs, termination clauses. Technology. Verify fixed protocol support, API documentation, platform compatibility, redundancy mechanisms. Regulatory stability. Ask about licenses, prime brokers, capital adequacy, fund segregation. Search for regulatory actions. Choosing counterparties evolves with growth. Start with POP or Tier 2. Add aggregation. Negotiate Tier 1. Run hybrid models to optimize profitability. Key principles. Both A-book and B-book are legitimate business strategies. Choose based on risk appetite and target clients. Aggregators provide redundancy and pricing advantages at meaningful volume. Test rigorously. Verify claims through hands-on testing. Build optionality. Avoid long-term contracts with harsh exit terms. Your infrastructure determines whether you compete on quality or just collect spread markups. Superior relationships win institutional clients and retain profitable retail accounts. Ready to upgrade your execution infrastructure? We specialize in connectivity, aggregation technology, and white label solutions.